Today, we're going to tear into an investment classic that is still, decades later, completely shaking things up. It's Philip Fisher's Common Stocks and Uncommon Profits. But this isn't just about stocks. We're going to get inside the mind of the absolute genius who wrote it and really explore the philosophy that changed the investing world forever. And just to set the stage, check out this incredible quote from Philip Fisher's own son, Ken. Think about that for a second. If it took the author's son 15 years to really get it, we're obviously not talking about your average how to invest guide. This tells you right off the bat that we're diving into some seriously deep, powerful stuff here. And that's really the heart of it. To understand Fisher's methods, you kind of have to understand the man himself. So think of this as a story about a truly unique mind and how that mind produced ideas that just flew in the face of everything Wall Street thought it knew. All right, so let's pull back the curtain. Who exactly was the guy behind these principles that have guided some of the world's absolute greatest investors? Well, Philip Fisher was not your typical Wall Street titan, not even close. His own son called him weird. He was apparently pretty socially awkward, insecure when he was young, and just so far ahead of the curve intellectually that he graduated high school when he was only 16. He even said that at Stanford, he learned more just from driving a professor around and chatting in the car than from any of his classes. And yet, this is the guy who would become a legend, an absolute icon in the San Francisco investment world. And this is so important to get. His unique personality wasn't just some quirky little detail about him. It was the very engine of his genius. Because he saw the world from a completely different angle, he could spot opportunities that were literally invisible to everybody else. There's this one story that just perfectly captures how he thought. So picture this. He's at a conference and they hold a contest to guess the Dow's closing number for the next day. Now, most people, they write down small, safe numbers, right? A little up, a little down. Not Fisher. He wrote down up 30 points, which was a massive move back then. And he won. Why'd he do it? Well, he figured if he was right with a small number, everyone would just say it was luck. But if he won with a wild, crazy guess, they'd think he was a genius. Turns out, the Dow surged 26 points and he won. The man just understood probability and perception on a whole different level. So how did a mind like that actually approach investing? Well, it all starts with his most famous concept, something he called scuttlebutt. And trust me, it's way less about spreadsheets and way more about being a detective. So what in the world is scuttlebutt? Well, think of it as the art of getting the real story. It's about getting away from Wall Street, going way beyond the glossy annual reports, and actually talking to the people who know the company inside and out. Its competitors, its customers, its suppliers, even people who used to work there. The whole point is to build this complete mosaic, to see the business from every single angle, not just the shiny, polished one the company wants you to see. And here's how it actually works. You go talk to a company's competitors to find its weaknesses, its blind spots. You find its customers and ask them, hey, why do you really buy this product? You track down former employees to get the real, unfiltered scoop on what the culture is actually like. It's all about that on-the-ground intelligence so you can see if the reality of the business truly matches the hype. Okay, so you've done all your detective work. Now what? How do you process all that information? Well, Fisher created a framework for that. A seriously powerful checklist for spotting the truly elite businesses. The 15 points. This thing was a gauntlet, a 15-question test that any company had to pass with flying colors before he would even think about investing. And these weren't just about number crunching. No, they were about digging deep into the fundamental, long-term quality of the business itself. His first big pillar was all about the business itself. He was looking for companies that were built to last, future-proofed. Does it have products with a long runway for growth? Is its R&D actually creating real breakthroughs? And this one was huge for him. Can they actually sell what they make? Fisher knew that a brilliant invention is totally worthless if you don't have a world-class sales team to get it into people's hands. Next, he focused like a laser on the people. For Fisher, the quality of the management was everything. It was an absolute deal-breaker. He wanted to see a deep bench of talent, a culture where employees felt respected, and above all else, unquestionable integrity, right from the very top. He knew that a business run by sketchy people is just destined to fail its investors. It's that simple. And finally, he looked for what we would now call a strong moat. Is this company the leader in its field? Does it have some kind of durable advantage like patents or some secret sauce in its tech that keeps the competition at bay?
And maybe most importantly, is the management focused on the long game? Or are they just obsessed with hitting the next quarterly number?
Okay, so you've done the scuttlebutt. The company passed the 15-point test with flying colors, and you've bought the stock. Now comes the hardest question for any investor. When do you sell? And Fisher's answer? Well, it was revolutionary.
His advice was as simple as it was profound. You don't. His whole belief was that if you have truly done your homework and bought an exceptional company, the best time to sell is almost never. See, the goal isn't to just trade little pieces of paper. It's to become a long-term owner of a fantastic business. And you can really see the massive difference here. The typical approach is this frantic game of trying to time the market, jumping in and out, obsessing over every little wiggle in the stock price. Fisher's approach was the complete opposite. He just ignored all that noise, focused only on the quality of the business, and had the guts to hold on through the market's wild swings, knowing that true quality would win out in the end. And this all led to a set of really powerful don'ts. Don't get suckered into those flashy companies that have a great story but no profits. Don't just do what everyone else is doing. Don't follow the herd. Don't diversify so much that your best ideas get watered down. And if you've found the right business, don't agonize over trying to get the absolute perfect entry price. Just buy it.
Okay, so these ideas are from a totally different era. In our world of high-frequency trading and a 24/7 news cycle, what can a guy from the mid-20th century possibly teach us today?
The answer? Pretty much everything. His philosophy became the bedrock for so much of what we think of as smart, modern investing. When you hear about legendary investors like Warren Buffett, what you're really hearing is a direct echo of Philip Fisher. Buffett himself said his strategy is basically 85% his mentor Ben Graham and 15% Phil Fisher. Fisher's DNA is woven right into the strategies of the world's greatest investors. And, maybe this is his true legacy. His son Ken said that his father's greatest gift was being like a mirror. His ideas and his writing help people think for themselves, to find insights they didn't even know they had. He didn't just give people answers, he taught them a better way to ask questions.
Which leaves us with one final thought. In today's market, which is just flooded with data and obsessed with what happened 5 minutes ago, has Philip Fisher's patient, detective-like approach actually become more relevant than ever? Maybe the ultimate edge is no longer about speed, but about depth.